myself, I'll talk a little bit about the buy and hold process and why I think it's probably the best strategy in building wealth in real estate. Long term, there's some other strategies obviously that are great for cash flow and trying to generate income. But buy and hold is like the biggest wealth builder, that in my opinion in the real estate game. So obviously, well, we'll get into introductions here in a minute, but we got Jamie here tonight. Jamie's with Alcova Mortgage. I've used him almost since I started, with my loans and my clients' loans and things along those lines. And Jamie's been with me through the start of my investing career too. So he answered all the crazy off-the-wall lender questions when I'm trying to put a weird deal structure together and things like that. So definitely good to have him here tonight. We're going to get into what is buy and hold, why we do it, some of the strategies behind it, and then things to look out for. And that's really what I wanted Jamie to touch on is especially when you're looking at refinancing or trying to have, a big rental portfolio, there's things that you need to watch out for and terms and, rules and things like that need to be abided by. So you don't want to get yourself in a situation like I almost got in, a couple months ago, and I'll get into that in a minute too. So without further ado, we'll get started. Hey. So what is grid? There's some new people here, which is great. We're always trying to get new people out. Really appreciate you bringing, people with you if you got value out of it last time. Grid is a U.S.-based real estate investment club or group, I guess you could say. They started up in Northern Virginia and have grown rapidly up there. And we're starting to see them, in the Roanoke Valley, the New River Valley, obviously. They have them in, I think, Knoxville, Tennessee. There's some out close to Denver now. So it's a spreading group. And, when I first started looking around, was like, I was kind of surprised that there wasn't anything like this already out there. So they add a lot of framework and structure to us getting together and talking about stuff. And, all out here, real people doing real deals. There's no gurus here. There's no fee or, nothing we're trying to sell you besides real estate, but, it's very open forum here. So that's Grid. Leader intros. I'm Cody Jernell. Grew up here in Giles County. Went to Virginia Tech. We have a brokerage and a property management company here in Blacksburg. And, I have a passion for real estate investing and wealth building and kind of passing the knowledge and experiences on that I have, going through it. So that's why I formed this group. Jamie, you can tell them a little bit about yourself at this point if you like.
Jamie Roberts, as Cody said. I'm with Alcova Mortgage. Been in the mortgage business. In June was 20 years. Seen a lot of changes in the market from the first refi boom in 2005. Market crash 2008, rate drops 2012 to where we are today at 7%. So seen a lot of changes, seen guidelines tighten up, loosen up. We'll go over a lot of those guidelines. Actually, within the last, 6 months or so, there was a big change in investment property financing that we'll get into. And so anything that I'm talking about, feel free to interrupt me. Ask questions at any time. I welcome any and all questions.
Perfect. So I want to go around the room quickly. It really helps to get to know the people that are in the room. Obviously, this is a networking group as well. So, we got people in here in different industries, different experience levels. And I always like to share that with everybody because you never know, person sitting beside you might be able to, 10x your business on certain things that you do. So we'll start on the right here. Mikhail, if you don't mind.
Mobile home parks, duplexes, single families. Glad to learn stuff, meet new people, get to know everybody here.
Perfect. Go ahead, Walker.
Walker Woodbury, just now getting my feet wet, so first time, that's great to have.
Absolutely. Walker did a really nice kind of fix and rent in Giles County that he's just about to get rented out. So that was a good project. Go ahead, Zier.
Full-time, just kind of on the side, hadn't been a whole lot there lately. 4 or 5 rental properties for the GX clients full-time. So the clients is great. You're properties, there's coming out.
My name is Josh Luplo, so I'm a buy and hold investor. I have a nice little portfolio. Been investing for about 10 years, and I'm also a lender as well. So overseas the state of Virginia, short term, a lot of short term.
Morgan?
I'm not an investor, but I have clients who here for
That's good. Morgan's one of our agents. She's an aspiring real estate investor. We're going to get her in there at some point, but it's good to get here and learn for your clients too, because you need to be able to have that conversation with them. So, go ahead.
For me, Jamie Connor, I work with Cody, Bradley, and we're all here learning and here's all our clients.
Great. Bruce too.
Yeah.
Yeah. You want to tell them a little about yourself, Bruce?
Yeah, revenue, also investor, self-investor, residential properties.
I will say one thing about Bruce. I probably haven't told him this, but he helped me out on my very first rental deal that I bought. Kind of walked me through the process and showed me what was possible. So Bruce, that's what got me to this place. So it meant a lot, and that's why I started this group, because it only takes one person to flip that switch for you and change your life. Yeah, exactly.
The first one is the most difficult, I would definitely say.
Absolutely.
The property that I bought, my wife was pregnant and had a 2-year-old and tow and had no money and just did it.
Yeah,
It
perfect.
was a good move.
Love it. Kristen?
I'm Crystal. I also work at Alcoa. I am James' processor and his wife.
She keeps the wheels on.
Yeah, you're told what to do at work in it.
Yeah, that's right.
I'm Don Bailey, I'm from Christiansburg. I'm a contractor. What one will I have now?
I know the feeling.
I'm Alan Squires, I'm a civil engineer, and I'm a assistant director of utilities for the town of Christiansburg. And do a real estate on the side. I kind of cashed out, and I'm looking for a new project.
I'm Cindy Clark. I'm a realtor with Facilities, and also we have properties together with two obviously for that, but I'm starting slow. This one has been all
Same thing.
He's not a realtor.
It's good for you. Go ahead, Ed.
Ed Kazusko, I am a full-time employee at Capital One. I live in Richmond. We've got 3 boys here in town, 2 boys here in town, 1 in Farmville, all college students. We own 3 single-family houses here that we are renting and hoping to get more. This is our retirement strategy.
Absolutely.
You know, once we get through paying for college, we're rental houses into income. Would love to get into duplexes.
Sure.
I think we're leaning a little more Richmond right now for our next house, but we're still up in the air.
Sure. Yeah.
I'm his wife, Annabeth, so pretty much all the same except for the Capital One.
It's good. It's a good duo. So Josh is actually also from Richmond, services that area, so it'd be good. Wasn't sure if you guys connected or not. Go ahead, Alexis.
I'm Alexis. I work at the property management company, property manager.
You also make sure the wheels don't fall off. So it's much appreciated. No, that's good. So make sure you guys, talk to each other afterwards. We usually go next door to Iron Tree and grab a few beers and talk. So that's probably my favorite part. Not just because of the beers, but like the connection of it. Great. Well, just always have to do this. Anything that is said here is not legal advice or financial advice. Do your own research. Talk to your accountant, financial advisor. We talk numbers sometimes, but it's not specific information. And then the other disclaimer is we have some video, photos going around. Sometimes those get shared out. If you're not comfortable with being on social media or anything, we're not going to have any close-ups of your face or anything. But let me know, and we'll make sure that we kind of take that out of the queue. So, what is buy and hold? you know, a lot of you guys have experience, but really comes down to, you know, the property that you purchase with the intent of owning for a long period of time. In my book, you know, it might change for other folks and what their time horizons are, but anything from a 5 to 10 year plus time frame is buy and hold in my book. Anything below that, you know, you're kind of looking at a shorter time window. You're not able to take advantage of all the perks of buy and hold, depreciation, you know, cash flows, things like that. But we all know that sometimes, you know, money talks, and the right person comes along, then plans change. So, you know, that's the biggest thing. This says 6 to 12 months or less, but you know, I still think if you're selling within a year or two, it's probably a short-term project for you. So, why buy and hold? So, you know, multiple factors go into what make buying and holding probably the best wealth building strategy. You know, if you're focused on income or you're focused on just generating as much revenue as possible, you might look in different areas. But when it comes to real wealth building, you know, we'll get into it in just a sec, but there's a lot of factors in the buy and hold market that really increase your net value or net worth and the value of the investment that you just made. I'm sure you guys have seen, most of you have probably seen this quote. I didn't realize it was Andrew Carnegie that first said it until I Googled it today, but 90% of all millionaires become so through owning real estate. And I underline and capitalize owning because, again, you really don't get that real wealth building until, you know, you hold it for the long term and even sometimes pass it down generationally. So that is, you know, that still rings true today, even though Andrew Carnegie's not around. So this, I don't know if you guys can see that in the back, but I found this diagram that kind of speaks to what I've been saying. You know, there's really four strategies or perks to buying and holding that make it such a good tool to build wealth. I'll try and break this down for you just by color so you can see it. This is our wealth building chart. So the purple line is what your purchase price was. Obviously, when you purchase the property, if you're buying and holding it, purchase price never changes. You could, I guess, say that's actually what your loan amount is because you're probably putting some down. We're talking about equity in this chart. So from where you have your mortgage, you have appreciation, which is this line. So over the years, obviously it fluctuates a little bit depending on the market, but over time, that appreciation is building up while the original amount that you put into the property is staying the same. So that's your equity on that side. Kind of a double equity because in these situations, you have tenants that are paying down the mortgage, right? So you're also building equity on this downward trajectory here. So the longer you hold it, you can see that wealth gap, aka your equity, is building up in that property. So that's obviously your biggest kind of value add, I guess you could say. You're building up equity in a property. The longer you hold it, the more that's probably there. And then this second chart that you see down here is the cash flow. So again, after the 08, when we were doing Jamie can talk more about that, but there's a lot of adjustable rate mortgages out there on the market. So depending on where the rates were, that's where your rate for your mortgage goes. So a lot of folks now are buying packages that the payment's fixed over 30 years. So this red line represents your fixed rate on your mortgage. And then over the years, your rent is also going up on these properties due to inflation and just being able to raise those rents as you go. So you've got equity building both ways here. You've got cash flow appreciating over the years here. And then the fourth one, which isn't on here, is depreciation. So depending on how many properties you have, and I'm no accountant, I'm sure might be able to tell us a little bit better than what I could, but each property that you have, you can depreciate, over a certain amount of years and write off on your taxes. So I know some folks, and it's not necessarily the strategy that I go for, they're even willing to lose like $50 a month on their properties. I always want to be in the green on the cash flow side of things, but some people take that depreciation into effect a lot more than others, and they'd be willing to lose $50 a month if they're making, if they've got $7,000 to $10,000 of depreciation that they can write off on their income every year. So again, different strokes for different folks, not necessarily the way I would do it, but it is a factor that builds into that wealth building within this. So some long-term hold strategies. Jamie kind of checked me on this first one, and I made him check my math. But one of the very first things, if you're just getting into buying long-term rentals, one of the best ways to do it is do a live, fix, and rent. And I haven't coined that phrase or anything, but when you live in the property, you can buy something that's a little bit distressed if you're willing to kind of, work around the kinks. You can go as low as what, 5% most of the time? I mean, even 3.5%, I guess, if you're using FHA stuff.
Conventional 3% first-time home buyer.
Right.
Or, I mean, technically, you can even buy a USDA with no money down for first-time home buyer. And then that's kind of where the 6 months comes in.
Gotcha.
You may want it to be a little longer, 12, 18 months, before you find a more suitable property for you. But there's nothing that says once you move out of that USDA property that you can't rent it.
Gotcha. Nice. Yeah, so that's what these months are here for. So, you could move into a property. I think my first one I did 6 months is why that kind of stuck in my head.
You definitely did.
Jamie said it's supposed to be 12, so don't tell on me. But, you live in the property, you kind of fix it up as you go. You're willing to live with some, some kinks here and there, but kind of use your own income to chip away at the work, whether you're doing the work or somebody else is. And then after 12 months, you can go buy another one using the same strategy, rent yours out. And I'm pretty sure if you have a lease in place, right, they don't count that payment against you for purchasing the new.
Correct.
The new property.
So when you buy the second one, if you buy the first one using FHA or USDA, when you go to buy the second, those two loan programs are off the table. So the second one's going to need to be a conventional. Yep.
Which is, if it's your house, you can usually get down to 5, 10.
Yep.
Yeah.
So 5% conventional because you're not a first-time home buyer any longer. But you could potentially do a home equity, something of that nature, to pull the down payment out of the one you're turning into investment.
Gotcha.
And then, yes, if you have proof of a lease and deposit and first month's rent, then typically we can use that to offset the house payment on the departing residence.
Right. So I have, just as an example, I've got a client, one of my favorite clients, because she does this once or twice, every 1 or 2 years. But she'll buy a townhouse and she'll do 5-10% down on it, live in it for a while, fix it up as they go. Her and her husband love, kind of redoing bathrooms, kitchens, stuff like that. And then after the year's up, they'll turn around and rent it. They'll go buy another townhouse and we'll do the same thing to it. I think they've done that 4 or 5 times now. And they're just accumulating properties with 5-10% down payments. And they cash flow pretty well because they're buying them a little bit distressed, living with a headache for 6 to 8 months while they fix it up, and then turn around and do it again. I was doing that for a while until I got a fiance and 2 kids, and she will not let me move us into any more fixer-uppers. So that's off the table for me, but it's a great way to get your feet in the door and really build up your properties without having to overexpose yourself too quickly. I think it's a good strategy. So the second one is the BRRRR method. Most of you have probably heard of that. If you haven't, BRRRR stands for, make sure I don't butcher this, buy, rehab, rent, refinance, and repeat. So essentially you buy low, it's a distressed property, you rehab it, so you build up some equity in that property based on where you bought it, and then you put a renter in it. And you go to the bank, you show them, hey, this property is worth X now, they get an appraisal to value it, make sure that you're right on your numbers. But as long as you have 75, 85, 80% equity in that property,
depending on if you're doing cash or no cash
right,
out, 70 to 75.
and it's rented, they'll turn around and refinance it for you. Sometimes it's a cash out. Sometimes you need to leave your equity in the property, but at the same time, you're taking that, you're at least getting out what you put in it, and you've got a renter in it. And now you can take that money and go do it again at another property. Use that money that you've taken out as another down payment. So it's a good way to, kind of snowball what you're doing as far as investments go. That one this is the strategy that almost caught me with my pants down this year. So I bought a property, got a private note on it. I think we bought it at like $60,000. It needed about $35,000 worth of work. And at the end of it, we were running our numbers at like 165, 170 as far as the ARV, which is the after repair value. Put a renter in it for $1,400, but Fannie Mae and Freddie Mac changed their cash out refinance guidelines right in the middle of my project. So it went from a 6-month cash out. What my plan was a 6-month cash out, and now I had to wait 12 months to cash out and get out of that. But the big problem was the private note that I took. I was banking it on the 6-month rule for Fannie Mae, Freddie Mac. So that loan term was only 8 months. So luckily, it was a private investor that gave me the money that he was willing to work with me through it. But we had to kind of jump through some hoops. I had some nights where I definitely lost some sleep, trying to figure out what we were going to do. I looked at it 6 months. Hey, I'll be smart, give myself 2 more months to be in case anything happens with the renovations or renting it or anything like that. But again, considerations that you need to think about going into an investment. If you didn't know that, you could really hurt yourself. And honestly, he could have just taken the property from me because I couldn't have cashed out, by the end. I'm sure I could have found another private investor or something along those lines, but luckily he was willing to work with me. So we'll get into the nitty gritty of the rules and laws going into that. The next one's FHA multifamily rentals, it's supposed to say. So if you don't know, FHA, typically 3.5% down payment. You can buy, as long as you live in one of the units, you can buy it to a 4-unit building or multifamily property, as long as you live in one, putting 3.5% down. So you've got to live in one unit for
12 months.
For about 12 months, like the other ones. But you put 3.5% down on the fourplex. That year that you're there, whether you're fixing it up or not, you've got income from 3 other units. And then after that year's up, you can move out and rent out the 4th unit. It's a good way to accumulate some rental property and not have to put 20, 25, sometimes 30%. So that's another one. I mentioned subject to before. Not that familiar from my side of that. I know it's got a lot to do with like assuming someone else's payments on their house, but you take over the deed. And what's that?
Yeah, we ran into something like that recently, didn't we? Yeah.
Oh,
And
really?
so someone had approached with this same thing. And so I had Hannah send over the stuff. And so the issue is, in order from the lending side not to count the payment against the people moving out, we need a 12-month history.
Interesting. I had a guy call me trying to do a subject to today, but it was on an $800,000 listing, and $800,000 listing in Callaway. He was like, we'll just take over the payments, and like, dude, he owes like $780,000 on that property. What is your plan with it? He was like, well, we usually like to find people with a lot more equity in the property. I was like, you're not cash flowing that thing. I can tell you that right now. So that's not going to work. But there's people out there looking to do that. They're looking for somebody who just wants out from under a property, wants their payments taken over, doesn't care if they still hold the mortgage in their name or not, and will basically turn over the property to you. A lot of times people will rent it out, fix it up, and then cash flow it, but they don't actually have the mortgage in their name. So, interesting strategy. Haven't seen it done a lot here, but it's definitely out there.
And in that case, the mortgage stays at the
Yeah.
same rate, so it's potentially a 3% mortgage instead of the 7 we're seeing now.
Exactly. Yeah. So it's there's advantages of it. And if you find a seller that's super desperate or behind on payments or just needs the money to pay doctor bills or whatever it is, and they're okay, moving out, holding the mortgage, it can be a good situation. I just don't know enough about it to really speak to it.
If they're moving out and willing to rent for a year so that then we can get a year history of the payments, then that's probably doable. In this case, both parties, it's a situation where both parties are leaving the residence, going to separate places, and they're both interested in buying again.
Gotcha. So they wouldn't be able to wait a year.
Whoever reached out to me, like they did their right now, what I got was they each $5,000. They're just trying to sell it, and he knew what they owed on it and everything.
Wasn't that Draper house that I bid on, was it?
No.
Oh, okay. I was about to say, all right, back on the table. That was going to be a good little flip, but somebody beat me out. So the last one, and there's more strategies in this, obviously, just the ones that we've kind of dabbled in and know to talk about. But then the short-term and mid-term rental, the considerations are a little different. In those, there's a little bit more hands-on, depending on where it is and how you set it up. You can cash flow better, but it's a little bit more management intensive on the short to midterm rentals. But it can be another good way to kind of, buy and hold a property for long term. That one's more kind of running a business heavy than your long term 12-month lease and stuff like that. But it can be a really good opportunity. All right. So some considerations. I'm going to kind of breeze through some more of this because I want Jamie to have a good time to talk, because the financing piece is like a huge deal for all of this stuff. But again, there's different considerations for the buy and hold strategies than from your average like fix or flip. One of those being how much free cash you have to take to market. It costs money to buy real estate. So if you have to go the traditional route where you put 20, 25% down, you got to make sure that you're comfortable with setting that money in a long-term investment, letting it sit there, and not being able to access it. I always joke with people. I say, I've almost got $1 million worth of net worth in real estate. But if you need 20 bucks, I'm gonna need 30 days. So I can take a line of credit out or something like that. So then you want to think about what your long-term strategy is. Are you investing for, the income, the cash flow? Are you trying to, build for retirement? Are you really just trying to increase your net worth so you can borrow against it, get to that accredited investor stage? Or is it's a mix of both? You really just got to figure out what works for you. What your tolerance for risk is. When I was first getting into it, I was pretty skittish about, real estate investing. It seemed like this big, this big lofty thing that you had to have a ton of cash to do and knowledge and everything like that. So I said, long-term holds are going to be the way that I start. Minimal cash up front because I was doing the live and fix and rent model, and then I could kind of do it as I go, and building that value, really lowered my risk tolerance because you're sitting on a ton of equity after the value add. So that's another thing to consider. And then what's your tolerance for dealing with rehabs? Are you doing the work yourself? That plays into your time constraints, the money constraints. Are you dealing with contractors? Are you going to be the one dealing with the tenants? Are you going to be using buyers and agents? Are you trying to do this on your own? Always suggest using buyer's agent at least, because in Virginia, obviously, the seller's paying the commission for that. And then some other things to consider. Where do you want to own and hold rental properties? You want everything to be in your backyard? Are you comfortable with finding a property manager or somebody to handle stuff that's outside your location that you can't personally get to? How long do you intend to keep it? We talked about that a little bit. How will you manage your first few properties? I always tell people, getting into it for the first time, probably a good idea unless you really just have no time or knowledge in it to manage them yourself. It's always a good idea for the first 1, 2, even maybe 3, try and manage those yourself. It gets you in a mind frame of what to look for. When you do go to get a property manager, they know that you know what you're talking about, so you're able to kind of keep them in track as well. No things to look out for. So it's just good experience to have those first couple under your belt, even if it's just for a year. You get tired of chasing people down for rent or figuring out how to pick up a check and stuff like that real quick. And then again, what's your rate of return that you're looking for in these? Are you comfortable having it in there long term, looking at it more as like a savings account versus an income generating thing? And then what rate of appreciation do you expect to see from it? So I'll just talk quickly on renovating it. We prefer, when we're looking at long-term rentals, for it to be something in the mid-range on the price. We're okay with it needing a decent amount of work because we have the contractors and the contacts to be able to come in and do it. But I've seen it time and time again where you're buying, these $20,000, $30,000 homes, and you're only planning on putting $10,000, $20,000 into it, and then turn around and renting it for $400 to $500. Yes, it is very easy and nice getting somebody in there quick, but the headaches that you're going to deal with a lower rent roll, and the tenants that attracts, a lot of times, at least for me, pushes any sort of that being a possibility out of my realm. I would rather pay more for a property, maybe either that or put a little bit more into it. Get those rents up to $900, $1,200, sometimes even $1,500 a month. Bringing in a good tenant that's going to take care of your property. You have less headaches on the rent payments. A lot of time you have less headaches on stuff breaking because you've already rehabbed the property. And when you're looking in those markets, those mid-market opportunities, usually in a better neighborhood that's going to appreciate faster. So your values stay stronger as well. Then it says the high-end properties too. Those are great, but I'm sure you guys know as well as I do with rates where they are, prices where they are. Good luck trying to cash flow something. Unless you have cash, a lot of cash. With a lot of these, we're just going in and fixing what's broken. We'll update countertops, we'll change out light fixtures, fix flooring, stuff like that. But we're not going in a lot of times unless it's a project that has to have it. We're not going in and tearing everything out to the studs and redoing the whole thing on these types of investments, the long-term holds. We just want to get it back up to where things aren't breaking, the tenants are safe, they feel comfortable, and it's a nice environment to be in, so they'll stay there longer and you command higher rents. I didn't write this slide, so yeah, I guess so. The only exception to that is if the place does need a full renovation. Obviously, it makes sense to come in and put nice stuff in it, make sure it's back up to snuff. But again, you're considering how much you're buying it for, but you're also considering where you're buying it. It's one thing to buy a $20,000 property in a $300,000 neighborhood and put $100,000 into it. It's another thing to buy a $20,000 property in a $100,000 neighborhood and then put $100,000 into it and try and rent it out and make the numbers work. So those are just things you have to consider when you're going into the renovation. And then lastly, shameless plug. It really does come down as you're building your portfolio, like if you're using a property management company or have the time or the systems in place to do the property management yourself in-house. It's always a good idea. Like property management company, a lot of times will charge anywhere from 8 to 10% of the gross rents. We have a friends and family discount that we work with our people in-house and friends and family too. I don't like managing property for family for a lot of reasons, but so a lot of times it'll cost anywhere from 8 to 10%. I've seen in higher markets or bigger markets that can be anywhere from 12 to 15%, depending on what the property is. And then a lot of times, and we do this only on a turnover, they'll charge either half or 1 month of the first month's rent as that leasing fee. So that covers a lot of times, like the pictures, all the showings and leasing activities that we have to do, taking all the inbound calls, running credit reports, background reports, stuff like that. Just a way to compensate ourselves for the time and the staff that we need to go into it. For stuff that property management companies handle, like we said, all the marketing. We take professional photos of our properties, get them up on all the sites, Zillow, apartments.com, any of the other syndicated sites that people are out there searching for. We pay for some extra add-ons that get the properties out there. We run credit, background, eviction checks on all of our tenants. We're pretty strict about what our requirements are in that. We've made maybe one exception over the years, and that one exception came back to bite us in the butt. So we're done with that. And then obviously we handle the rent collection. We try and get 90 to 100% of our tenants paying online so that we can distribute in a timely manner. Just makes things very smooth. And then handle any repairs, turnovers of the property. That's still paid for by the landlord, just so you guys know. But we handle the contractors. If it's an emergency situation, we get somebody out there, at 1 a.m. to fix the flooding basement or something like that, which comes in handy if you're trying to manage from outside of the general area. And then evictions. We've had, unfortunately, too much experience with that here recently. And actually the one that we posted about, we went by today, they set our trial date for October, but we went by today and he was already moved out. So that was a huge win for us. Alexis and I did a little dance today when that happened, but that one's over in Salem. We're actually going to start renovating it now that he's gone. Hopefully get that rented out pretty quick. good property manager, so be sending detailed monthly reports. Keep rents at or just below market rates. That's one thing I tell all of our clients that use us for property management. It's when you self-manage, it's really easy to fall into this trap of I've built a relationship with this tenant. I'm only going to raise the rent if I do even, just $25, per the year. We've seen whenever clients bring us properties that they've been managing for a while, a lot of times after that first turnover, we can bump that rent up like $400, $500. We don't like to do it whenever there's a tenant in there. We'll gradually increase to try and keep them in there. And, we just don't feel good about like kind of holding people's feet to the fire and screwing up their budget that bad. But we have found that with self-managed properties, a lot of times the landlords are not very aggressive when it comes to raising rents, even on turnover. So that's a big value add from us. And then again, we always do credit background checks, never accept excuses, no excuses. So that's, wanted to give you guys a rundown of just strategies, buy and hold, wealth building activities. But a lot of these things that we have talked about have a loan or some sort of financing backing it. And there's a lot of strategies there, a lot of things to consider when you're going into that. And there's also a lot of tools that somebody like Jamie can get on the phone with you and talk through with you. He said, maybe you can't do it that way, let's talk about trying to do it this way. And that can really kind of level up what you're doing investment wise. So I will turn this over to Jamie now.
Awesome. Thank you, Cody.
Absolutely.
I'm a little old school. I don't have PowerPoint. I have PaperPoint. All right. So I'll try and talk. I won't talk at you. We'll just all talk together. Stop me at any time. Okay. It's a fine line between giving you enough information to help you kind of figure things out and sitting here and putting you to sleep. Okay. So we'll kind of talk about 3 different scenarios: purchase, buying a rental or investment property. And then also, if you already own that property, then either refinancing it for the balance or doing what's called a cash out, meaning you refinance the balance and you pull some of that equity out. Okay. So when you're buying your first one, okay, it is going to depend on if you currently own a house. If you don't own a house and you're going to do what Cody said, you're going to live, fix, rent, then of course you can buy that first one using the first time home buyer program. Down payment could be as little as 0% up to maybe 3% conventional, 3.5% FHA. All right. Now, once you move out of that house and you rent it, naturally you're no longer a first time home buyer. So then you're pretty much looking at a conventional loan from there on out. Typically the next step, what I see people do, and depends on the location of the house, is the next one may be a second home. Okay. Benefit to second home is it's only 10% down. And so as long as it's not within a 40 to 50 mile radius of where you live, you can call it a second home. An exception is you live in Christiansburg, you have a second home at Claytor Lake. Well, that's believable because you have a second home. Or some folks may have a second home in Floyd, in the mountains of the country. That's believable. Living in Christiansburg and buying a second home in Blacksburg is not going to fly. All right, so keep that in mind. Everybody used to buy a second home, a football home in Blacksburg is what we call them. Maybe their children just happen to live in their football home. But the benefit was 10% down. Okay? About a year and a half ago, the second home thing became where everybody was buying a second home at the beach, college town, mountains, and that's when Airbnb really took off. So they're buying these second homes, and the intent for a lot of them was to use it some as a second home, but the primary intent was short-term rentals through Airbnb. Well, it didn't take Fannie Freddie long to catch on to that. So then they didn't change the down payment, but they changed the interest rates. Because a secondary home interest rate used to be similar to primary. Now it's similar to investment. So you can put less down, you just don't get the rate benefit. After that, then you graduate to when you purchase an investment property, you have to call it investment property. And so for that, Freddie Mac loan, you can get in for as little as 15% down. Keep in mind, you're going to have a high rate, less down payment, more risk, and you're going to have mortgage insurance, which is going to be pretty steep. Fannie requires 20% down. So somewhere between 15 and 25% down is going to be your down payment on investment property for a purchase. All right. If you do something similar to the BRRRR method that Cody was talking about, maybe get a private investor, something of that nature to purchase it with less money down, then we're looking at a refinance. All right. And for the refinance, you have to decide, am I just going to refinance the balance, or do I want to pull some of that equity out? Maybe you did significant improvements to the property and the value went up. So now you're saying, hey, I'm going to pull some money out to go to the next deal. That's where it comes in, what happened with code. Literally, I called him that day. It's not like Fannie gives us notification, hey, we're going to change this guideline, so any loans you got out there, you might want to get done. Literally, I walk in one morning, boom, there's a bulletin. Cash out guidelines have changed. It's been 6 months since I started business in 2003. Literally, no longer 6 months, now 12 months. I called him that day. I said, man, we got a problem. Because we had already planned this. I knew when he bought the property. We knew when we were refinancing it. Everything was going according. I said, we got a problem. Like, I don't know what you're going to do, but we got a problem. Yeah. Yeah. So my personal gut feeling is properties were appreciating so quickly that they were afraid of people doing a lot of cash outs, pulling max equity out, and then any kind of depreciation, all of a sudden they're upside down. And then if you're upside down, if you're going to walk away from a property and turn the keys in, what's it going to be? Not the one you live in. It's going to be the one you don't live in that you're upside down in. So they're trying to be a little preventative in that. So on a cash out, you have to own it 12 months before you can do a cash out refinance. If you just want to pull out and pay off the balance, then you can do it anytime. You can do it 3 months, 6 months, 9 months, whatever you want. So no cash out refinance, you can do it anytime. A cash out, you got to wait 12 months. 12 month season is what they call it. And your loan to value is a little more strict. You got to be somewhere, depending on Fannie and Freddie, 70 to 75%. Interest rates. On interest rates, natural investment property interest rates a little higher because it's a more risky investment for the investor. A cash out is going to even have a little more on top of that. So keep that in mind as well. Now, what happens if you pay cash for a property and you go in, you rehab it, and all of a sudden you're like, okay, I want to move on to the next one, but I don't want to wait 12 months. There is a guideline called delayed financing. If you pay cash for a property, you have 6 months to pull that same amount back out. Okay. Now they're going to check everything. Everything goes under a microscope. They're going to get your settlement statement to make sure that you paid. If you paid from a savings account or CD, something of that nature, they're going to get the statement. They're going to see where you took the money out and a settlement statement where you paid cash. But you are allowed to get that money back up until 6 months. 6 months in a day, if the refinance hasn't closed, it's done, it's over, you're waiting 12 months. Okay? If you borrowed money to buy that house, but not against that property, so there's no lien on the property, but say you got a private investor, or say that you used a HELOC to buy it. Okay? Any money that you get out of that property has to pay that loan off. So you can't use a HELOC and then use delayed financing to put money in your pocket. If you use a HELOC, the delayed financing has to pay off the HELOC. Yes? The amount you took out of the HELOC. Yep.
So if you got a $100,000 HELOC, they only use 50 to buy the property.
You just used but the 50 is all you can get out of the property too. Okay. Now, let's say that you use 50 to buy it. It's 4 months later and you owe 45 on it. Okay, you still can't get 50. You can only get 45 and pay that 45. The purpose of it is not a cash out to put money in your pocket. It's just to reimburse you for whatever was spent to buy it. Now, sounds like a lot of people here have a growing portfolio. Secondary market loans, is important to know that you can only have 10 financed properties. Okay? That counts your primary, that counts your second home, and then any investment properties that you have. Okay? Now, it's 10 financed properties. You can have 2 mortgages on each property. You can have a HELOC and a loan on each one. So say your primary, you have a mortgage, and you use the HELOC to buy the second home, then that still only counts as 1, even though it's 2 mortgages, but 10 financed properties. You can have 30 properties and only owe on 5 of them, and you still have 5 to go. But it's 10 financed properties total. Okay? And that is, yes, sir.
That's per person, so a married couple, if we set it up right for that one.
No. Okay?
Well, that
Yes. Well, so if you're joint on your primary, that's one. Okay.
One for both.
Correct.
Now,
Okay.
we have 9.
Yes. Yes.
Okay. So you could have 19 total.
Well, you could technically have, let's see, 10, 9. Yeah, 19. Yes, we'll get to that.
So
Yeah.
one
Well, not LLCs, but there are some
One
exceptions.
thing that Jamie and I talked about is Angie though, and I thought he might get this recently, is get up to that 10 amount, you can actually go to a commercial bank, get a commercial loan on all 10 of the properties, so bundle it all into one commercial loan, and then you kind of reset what you're able to go out and get individually.
Now, I'm going to tell you one way around it that would work maybe 1-2 times before they caught on. So you reach 10. You reach 10, right? You have a primary, and then you either have a second or you have non-investment, whatever you have. You could technically turn your primary into investment and buy a new primary because the rule does not apply if you are purchasing a primary residence. Now, you're going to have to move into it, okay? But if you got to that point and you want to turn your current home into a rental and buy a new primary, then that's a way to get around it.
But the current home that you had for your previous primary,
Turn it into rental.
turn into a rental does not count towards the 10.
That one counts towards the 10, but the new one does not because it's your primary. Your primary residence, if you're purchasing a primary residence, does not count towards that total.
It sounds like they won't give you the 11. But if you do the technique you're having, you can just continue to do that and have 11, 12.
Yeah, I wouldn't do it. I wouldn't do it annually, right? But you know, you can every so often. You know, they're not going to follow you around, but of course, it does show in your credit report how long the mortgage has been open. All right, so excluded from the limits, commercial real estate. Okay, so it's not necessarily the loan; it's the actual property. Multifamily property consisting of more than 4 units. And that's simply because anything 1 to 4 unit can be done on the secondary market. Timeshares, a lot, whether it's what we consider a developed lot, meaning it doesn't have a structure on it, but it does have access to water and sewer, or an undeveloped lot. A manufactured home, not counted as real estate. So if it's permanently affixed, and they've surrendered title and it's counted as real estate, then it counts. If it's still being taxed as personal property, then it does not count. A property in the name of the borrower's business, okay, but the borrower cannot be legally obligated on any debt to that. So if you sign any kind of guarantor, then that's going to mess you up. And then lastly, if it's in a trust and the borrower's the trustee, in his or her individual capacity, as long as, again, they're not obligated on any notes from the trust.
So you borrow just directly from your trust? Like could you, I guess it's a bad way to say that. Could you
Do the loan in the name of the trust? Not secondary market. Now, you can deed the house in the trust. But secondary market, same thing for LLC and everything like that. It has to be an individual with a social security number. They won't do any TINs.
But if you, just because you deed it into your trust, it's probably still your name's on it.
Personally, yeah, personal guarantor. Same thing for a lot of, even a house deeded in a business with a business loan, a lot of business loans still make you sign a personal guarantor to back the business loan. Rental income. So when you go to buy a rental property, one of the biggest questions is, can I use the rent to offset that potential payment to qualify? And in most cases, you can. Believe it or not, one of the first things they look at is, do you own a primary? And if you own a primary and you're getting a rental, even if it's your first rental, then you can use it to offset the payment, okay? Whether you have a lease, we'll use 75% of that. If there's not someone already in the property, then we'll have an appraiser estimate how much the rental will be. If you do not own a primary residence and you're trying to buy an investment property, then we can't use the rent to offset the payment. Okay? Same thing on a refinance. If you come to me and you're trying to do a cash out, no cash out refinance, if you have rental experience, then we're probably just going to look at your Schedule E in your tax return. Okay, this particular property doesn't have a full year. It's not fair to you. So then we'll take 75% of the lease. If you do not have rental experience, then they're going to typically just use 75% of the lease. Okay.
And that, I guess, going a step further, that plays into like your debt to income ratio of what you're able to borrow, right?
Correct.
For people that don't know what debt to income, how that factors in.
Yeah, but the benefit to doing that is, so we're going to count any debts you have against you, but by using that rental income, we don't have to count the new payment against you. And it helps significantly. And so without rental history, they're going to order an appraisal, have the appraiser see what it is, and see what the also what the lease is. And that's kind of like a security measure, just to make sure maybe like it's not a friend or family lease that kind of overshoots what the market dictates for that property. Questions? Come on, let's have them. So they can't do subject to because the folks that are going to take it over, okay, we have to have 12-month history of that payment being made. Now, if they want to, if your folks want to go rent for a year, and then in that 13 months say, here's 12-month history where they paid my mortgage on time, then we're good to go. But, and even if they had a rental history, it'd still be the same thing because it's subject to. Now, has anybody in here done subject tos? Have you done many of them or heard or anything? Yeah. Yeah, it's when Hannah, I told her, I go, hey, I'm going to do whatever people want, but this would scare the bejesus out of me, okay? Because literally the house is going in the new owner's name. Well, now let's be honest. If you're the one on the subject to side, then yeah, it's a great idea. But on the other side, what really concerns me is, and that's why I was sitting there, I was trying to think through it, and I'm like, I don't get how this is a benefit. Is because they are deeding it in their name, but the mortgage is still in other people's name. So if they stop paying, I know you have a contract, but let's be honest, people break contracts every day. And so good luck getting them out.
So I had my first listing with this one.
Okay.
The tenant was not there. So the owner had to withheld to get him documents. It says you have to get him off.
Right.
You have to go through that process. And it is, of course, it was my very first.
Well, that's a good one to break in on.
Is the implication here that in the subject to the original owner becomes a renter staying in the house? Is that what you're saying?
I think on the goal is to get that out. I think
Yeah.
it's geared towards people who might like be going to foreclosure.
Right.
Like that.
Right.
Yeah,
Yes.
they're usually in a desperate situation.
Yep.
I mean, they're not in that foreclosure situation. It's a separation situation. And then there's an adoption of a little boy that's like on balancing because of the time frame, because their situation isn't permanent. So it's just like, honestly.
You know, if you're the investor and someone's willing to do it with you, I think it's great. Simple for what you said as well. So you take over their note that, let's be honest, most everybody in the last 8 years either bought or refinanced, right? So it's typically starts with a 3, worst case it may be 4 something, versus getting one now that's in the 7s. Okay, so yeah, it's a great idea, but I see all the benefit on the investor side, and you guys are investors, so have at it. But on the other side, like when I was trying to think through it, I was just like, this makes no sense to
Well,
me.
the biggest thing with them too is that they were both trying to buy something.
Yes.
So they would still have that debt on their books.
Correct.
But they didn't own the house.
Right, and that's what we were trying to see is how can we get around counting that debt against them. Okay, and so that's what made me look up the guidelines, and you have to have 12 months.
It would be cool to get subject to expert.
It would. In that case, I mean, they'd be better off leasing it.
Right. Yeah. Because that would show, that would take some of that payment off there.
Yep. No, well, that's the other issue, right? Yeah.
They had to come together and agree on
Yeah, it's, yeah.
something.
Maybe Jared can tell us. Tell us about some subject too, Jared.
Well, on that specific one, that's why I was like, trying to apply what I've learned.
It would have worked if we didn't have count payment against them.
Yeah.
Right. But then they don't get any, they don't make anything, even though they may only make 5,000-7,000 each, then they're probably not going to make anything, right? I'm assuming they were just offering them probably what they owed on it.
Yeah, I mean, in most of these situations, from my understanding, you, as an investor, you still got to pay all your commissions and fees and all that, so you still either borrow from private money and pay that, all the closing costs, fees, and all that, and then plus the difference of whatever that seller is wanting.
Yeah, a lot of times you bring them like 10 grand. And
Yeah, or they're out, and they're just trying to get out.
Right.
Yeah.
People that like don't know what else to do, and then you're like.
Well, yeah, and in those situations, they're most likely are going to rent for short term until they can kind of, the smoke clears and get everything figured out.
What are the differences in rates right now between like conventional, like secondary market and commercial? Are they like a point spread or?
So for commercial, the biggest thing with commercial rates is typically you're not going to find it fixed. You're going to find 3 to 5 years. They want to review it every 3 to 5 years, payment history, things of that nature. So you're going to be on some type of arm, and it's typically going to be a shorter term, maybe 15, 20 years, maybe 25. One thing I am seeing in investment rates on the secondary market side is, there used to be this huge gap between primary and investment. Well, rates are so high, there's not as large of a gap, but you're having there's like you don't have an option to not pay any points on investment. Yep, there's no par rates. So you're still getting a rate that's not that far off from primary, but you may pay 2 points for it.
Another question I had, because of the deal that Mikhail and I are doing right now, we're trying to buy a trailer park. I know this is commercial, but it can probably be applied to residential stuff or secondary market stuff. But we got the owner to agree to a price, and then he was going to owner finance the down payment for us at like 2%, which is awesome. But we were going to use that as down payment and just pay the closing costs and whatever we needed. But the bank came back and said, "We still need you guys to put $20,000 down."
Yeah.
How does that work on like secondary market, or like when you're looking at like an investment property that's like a single?
We still being recorded? Because if you're going to do something like that, a seller financing, like nobody needs to know about it. That needs to get recorded a couple months later down the road or something like that. Because at that point, like, you don't have skin in the game.
Like they don't know that it's not your cash.
Yeah, because he was adamant about we like our investor to have skin in the game.
Yep. Yep.
Yeah.
So
Yeah.
now we're going back and saying, okay, well, it's going to be a $50,000 note down payment, and you guys are okay with that because you told us you'd do 80% loan to value. Like 50,000 is still 80% loan to value. Since we're at a 320, can we just do 30 from the note, or does this need to be 20 on top of the 50 that he's given us?
They're most likely not even going to count anything on that 50 because it's technically not coming from you. Think of it like doing a piggyback loan, like the old school 80-10-10 or 80-20.
Yeah.
Okay?
Yeah.
So if you did an 80-20, you didn't technically have any down. Yes, your first mortgage is 80%,
Correct.
but you also had a second lien.
Yeah, yeah.
So you didn't have any down payment technically in it. Okay? And so even back then, we would do 80-10-10 or 80-20, and the seller could do a privately held second. Okay, and so in your case, that's the same thing, except for now they're not going to do something that's 100% financing on a commercial loan.
It's like 80-20-10, essentially. Or I guess,
80-10-10.
yeah. So we could turn it back to
Yeah. So all they would do is, like, if let's say it was 100,000, I know. So let's say it's 100,000, and so it was going to be, he was going to do 70 mortgage and then 30 for the seller, right? Well, they still want you out of that 100, they want 20%, so they want 20 from you. And so then if the seller's putting in 30, all they're going to do is take that first mortgage from 70 down to 50.
Yeah.
So they're basically having to leave the skin in the game.
Basically, we should just not accept it. So they 20.
We should have had this a month ago.
Yeah,
We should have had
exactly.
it a month
It was
ago.
last month.
Yeah.
Yeah.
Okay. Anybody else? Well, thanks for coming.
Yeah.
I guess lastly, kind of next steps, like we've got, these links aren't right, but we've got a Facebook group, Grid Blacksburg Investors. That's where we put a lot of like deals. I feel like I'm the only one that posts in there. Has anyone tried to post in there? Like, I want to make sure I don't have like a setting set where I'm the only one that's allowed. But I want to get that to be a point where everybody's posting deals in there, opportunities, guest speakers, whatever you think, even like YouTube videos, stuff like that. So go join the Facebook group. I've finally got my external hard drive for my computer, so I'm going to send the previous grid recordings, including this one, to the Grid HQ people. They're going to put it on YouTube. If you ever want to go back and watch any of the recordings that we've had, they'll be the long form. And then next month, we do this. Next month, September.
Yep.
I might actually have a conflict next month. So I'm either I'll find somebody to do it in my place, or I might have to move it. But typically, it is the last Wednesday of every month, 6 o'clock. I've been doing it here. It's been working pretty well. So I'll probably keep that going. But bring a friend. Again, the bigger the group, the better network effect we're going to have. If you have any ideas for topics or guest speakers or anything, I'd love to hear them, and appreciate you guys coming. So that's it. Thanks, Jamie.
Yes.